All right, short seller David Tice says the stock market rally will not go for another 6 months. David is chief portfolio strategist for bear markets at Federated Investors. He joins us from New Orleans to discuss why he thinks the markets are headed lower, the dollar is headed lower, pretty much everything's going down. David, let me start out by talking about the greenback there because it's been such a hot topic lately and continues to lose ground. You think the dollar index could head below 65. Do you see any kind of government intervention? We were just talking with Christina Romer. She gave basically the party line. Do you see any kind of government intervention coming into this deal?
Well, Matt, we're wondering offline if Treasury just realizes that with all the borrowing that we have to do, that the dollars just has to go lower. Obviously, Treasury can't say that to the public markets. However, if there's not some recognition that that's essentially baked in the cake.
I wonder what you think about that as a policy to obviously make your debt cheaper to pay off and an attempt to boost imports. David Malpass has been on the show, though, a couple of times saying it's really the worst policy you could choose, and historically it doesn't pan out.
Well, Matt, we've said all along that we need some recognition about how our economy is broken and how we have essentially borrowed way too much money from foreigners. This Keynesian theory, we believe, is broken as far as this fiscal stimulus. You only need to look at Japan. 20 years after they peaked at 40,000 on the Nikkei, where they're 75% below that level, their debt's about ready to hit 200% of GDP. We're essentially facing the same problems. We have to spend less money. We have to get our consumer used to shopping less, going to movies less, et cetera. We're going to have to close down some of this luxury consumer infrastructure. That, in our opinion, is the best policy.
I wonder, I had Lakshman Akithan on earlier from the Economic Cycle Research Institute. He would say that in the 20th century, the best thing that we have done in economics was figure out business cycles and figure out ways to sort of limit the pain with Keynesian fiscal stimulus. Why doesn't this make sense to you? I mean, isn't it humanitarian at least?
Well, in our belief, Matt, what that's done, and we couldn't disagree more with this gentleman, is that we have created rolling bubbles, bubble after bubble, in order to prevent the economy from cleansing itself. We're creating these excesses and imbalances with total market debt as a percentage of GDP exceeding 370%. It essentially goes higher and higher and higher, and we've essentially bailed out the economy each time, but now we're going to create a massive bust. We should have had smaller busts along the way and therefore cleansed the excesses, and now we're going to have a big one.
And you think especially in the form of a stock market bubble burst, right? Because we're looking at S&P, 1071.5 at the close, and you think it'll bottom out at some point at 400.
The stock market has a long way to fall because GDP is going to fall. We're going to have to work off debt. Unfortunately, we see a funding crisis down the road. Interest rates are going to have to go higher. The dollar's likely to go lower. We're in a heck of a mess here. And in fact, we're in a mess globally. Japan has massive problems. China has problems. Europe has problems. Unfortunately, this is quite a state of affairs.
Does it come to, at some point, the Chinese and the Japanese refusing to buy U.S. Treasuries? Is that a concern of yours as well as it is of many other bears?
It certainly is. And the Chinese are very, very worried about our current monetary easing, our current spending. The Japanese are as well. We've had a change in government in Japan. Japan is not saving as much anymore. In fact, their big public pension fund is going to start selling JGBs. They just announced in June that they would likely have to start selling them in order to pay benefits. That's a huge change.
What do you think about Treasury's support for debt? I mean, we've seen the Fed and Treasury help out as far as Treasury notes are concerned. Is that a concern of yours when that support falls off?
That's a huge concern, Matt. In fact, the second quarter Z1 put out by the Federal Reserve showed that nearly 50% of Treasury issuance was purchased by the Fed in the second quarter. The Bernanke has talked about that buying of treasuries being curtailed, also the buying of agency debt as well as mortgage-backed securities being curtailed. Eventually, the Fed will have to sell some of those securities. We just don't know where the buyers are going to come from, and we think it's inconsistent with the zero interest rate policy.
I'm assuming that you think we see another dip here in the first half of 2010 as far as GDP, and unemployment continuing to climb to scary levels here. Do you foresee more stimulus? Do you foresee another push to support treasuries, et cetera, from the Fed and from Treasury?
It all depends on what happens with the dollar, what our foreign creditors say. We certainly know that Congress, if unemployment goes up, GDP declines again, they'll want to throw more money at this. The question is, Congress will be like a drunken sailor. They'll continue to spend money until it's taken away from them. So the question is, will there be a funding crisis to prevent that? At what types of rates will we have to pay at that point? Will it keep going for a while? That's possible as well, but it's an extraordinarily risky time.
What does it look like to you? I mean, if you see the S&P coming down to 400, if you see the dollar dropping below, the dollar index dropping down to less than 65, where do you see unemployment peaking out? How far do you see GDP coming down?
Well, we're already at 17% in terms of all-in U6 unemployment. Stated unemployment is not quite 10%. I think stated unemployment could easily go to 14, 15 or so. GDP could decline potentially 10, 15% down the road.
And then inflation. I mean, a lot of bears are concerned now not about inflation, but about deflation. Do we have a bout of serious deflation before you see the kind of hyperinflation that I'm expecting you to forecast?
There's so much capacity out there, Matt, and certainly deflation is the problem right now. We do think with the Fed's willingness to provide debit cards to people for unemployment. After Katrina, we provided debit cards. Normally, you have deflation when you can't match up willing lenders with willing borrowers. If the government's willing to give money away, it's likely to lead to inflation down the road. But I do think you're right. I think deflation is the immediate problem for now.
All right. Hey, David, thanks very much for joining us. David Tice coming to us from New Orleans.